Nada, zero, zilch. That's what the Dow did today. It literally finished unchanged, closing exactly at the same level where it did yesterday. It's only the third time that has happened since the year 2000. The Nasdaq also had little firepower today, but it did hang on to log its 15th record close of the year, and the S&P hit an all-time high intraday, but failed to finish there. So here are the final numbers for this day. The Dow, it'll sound familiar, finished the session as it did yesterday at 27,691. Nasdaq was up 21. The S&P added 4. Now, even though the major averages are at or near these new all-time highs, the rally doesn't feel like your typical move higher. So we asked Mike Santoli to grade this recent run-up.
The stock market's run to record highs has taken many investors by surprise after a late summer bout of recession warnings. The question now is whether the rally is on a firm enough foundation to carry on. The short answer is the market's climb rates pretty highly on technical and fundamental grounds, but at some point in coming weeks or months, overexcited investor sentiment and stout equity valuations could present a challenge to rapid further gains. The push to fresh highs on the S&P 500 to 3,100 has been impressively broad and has been accompanied by notable strength in foreign markets as well. The tally of individual stocks climbing versus those dropping has also made fresh highs along with the indexes, suggesting healthy participation in the rally, and sectors most sensitive to an upturn in economic growth have led the way in recent months, including industrials, financials, transports, and semiconductors. The non-U.S. stocks have done even better than the S&P since August. That's a signal the economic activity is gaining traction worldwide as bond yields lift from record lows. The market's response to better than expected third quarter earnings, which are still down slightly from a year ago, suggests investors view last quarter as the low for profits ahead of better numbers in coming quarters. And the market's upbeat action since the Federal Reserve indicated it is not looking at further interest rate cuts also stands as a vote of confidence that a soft patch in growth has likely passed. The hazards now are potential overconfidence and full valuations. Investor surveys and gauges of trading activity show a sharp jump in optimism, which is a positive until it carries too far. And S&P 500 valuations based on expected earnings are near their highs for this bull market, meaning it is crucial for profits to start growing again if this rally is to carry through year end and beyond. For Nightly Business Report, I'm Mike Santoli.